we have the first ABCD swing, which creates the first liquidity zone, which was taken out right here, after which another ABCD swing was formed, creating a second liquidity zone, which was then taken out right here. Hi guys, how are you doing? Hope you're catching those pips. You're welcome to Tom's Capital. If this is your first time on the channel, here we teach traders how to view the market with the eyes of a smart money trader using market facts and institutional data. If this is what you like and want for yourself, waste no time, join the Tom's family by smashing the subscribe button and turn on the post notification bell so as to be notified whenever we drop our videos. I'm super excited to bring you today's video because the video is all about liquidity. Forex trading and trading in general is all about buying and selling, which will flow and run properly and smoothly only when there is liquidity. The word liquidity is used very loosely these days, to the extent that many traders don't even know what it means and how to rightly and efficiently apply it to their trading. So, what is liquidity? Liquidity is a measure of how easily an asset can be exchanged. That is, how quickly you can get money out of an asset. This means an asset that can easily and quickly be converted to cash has high liquidity, and the reverse is for low liquidity assets. This explanation and definition is in terms of an asset. What about in terms of a market? A liquid market means there are always investors willing to trade at every price level. This means liquidity is a measure of the ease of buying and selling at a price. The measure of the ease of buying and selling at a price. Therefore, a price where we have a lot of willing buyers and willing sellers is a liquid price. This liquid price is what we mark on the chart as liquidity. In the forex market, we have two broad categories of traders, which are institutional and retail traders. In line with this classification, we also class liquidity into two types, which are institutional liquidity and price action liquidity, or retail liquidity. Institutional liquidity refers to the price zone where the big institutional traders accumulate their orders or offload them. Let's take for example the illustrations on the screen. The bullish and the bearish channels mark the institutional accumulation done in this contract period. The beginning of each channel is where the institutional liquidity lies. These institutional liquidity areas are perfect for swing trade entries and targets. In coming videos, I'll be teaching you how to identify institutional accumulation contracts and institutional distribution contracts. So I would advise you to stick around and watch out for that. Now to the other type of liquidity. Price action or retail liquidity refer to price zones where retail traders place their orders. This may be stops or limit orders based on price action. The illustrations on the screen show typical retail price action setups, which are all based on the ABCD price action swings. The first illustration, we have A, B, C, and D. The entry is at point C, target at D, and stops at A. On the second illustration, we also have A, B, C, D, with entry on point C, target on D, and stop loss at point A. The A point in both scenarios is the liquidity price zone because it is where the stop loss order of the buy trades are placed. Similarly, breakout sell limit orders are also placed in the same zone. This means retail sellers are heavily present there, which makes the zone a very good area for institutional traders to buy from the retail sellers. This simply means we have willing buyers and willing sellers present in the zone. That makes it a liquidity zone. In this video, we will focus on the price action liquidity, aka retail liquidity. In future videos, I will explain more on smart money liquidity or institutional liquidity. Just in case you don't know, price action is delivered by an Algo, commonly referred to as IPDA, which stands for Interbank Price Delivery Algorithm. So buy orders or sell orders are not what is moving price, although the algorithm is programmed programmed to deliver price based on the market dynamics, which is basically institutional accumulation and distribution. Very soon, I'll make a well-detailed video on the market dynamics and the market participants. If you would like to see this video, type I do in the comment section, like the video, share the video, subscribe to the channel and turn on post notifications so that you'll be notified when the video drops. In addition to liquidity prices or liquidity price zones, we have liquidity pools, which happens to be the most important one for all of us as members of the Tom's Capital family. Liquidity pools are zones where every retail buyers and sellers present have been induced by IPDA. These zones are where many stop losses and pending orders are placed by retail traders. But how can the Interbank Price Delivery Algorithm see retail stops and limits? Does IPDA have access to the order book of all brokers? I know these questions are flying up and down your minds right now. The answer to all these questions is simple and easy. Trading lessons and knowledge about price action is how IPDA is able to see, or in more appropriate times able to induce retail orders. IPDA creates the zones and traders are taught to place stops and limit there. The bitter truth about this inducement by IPDA is that it is neither a problem nor a solution. Traders cannot avoid it. Its main purpose is to create liquidity, that is a situation where many willing buyers and sellers are present at the same time so that trading activities can be carried out. Without it, trading will be impossible because we need buyers and sellers to trade. This is why I believe traders should focus more on trading the asset rather than chasing IPDA. Support and resistance, trend line, indicator, and most of these technical analysis skills that we learn are all ways of chasing IPDA. This explains why we can have 10 exact same scenarios in price action, but the result will be totally different and the trader is left to wonder what is really going on. In order to break the element of surprise, traders need to have directional bias prior to price action analysis. The truth is that price action is just for timing and zoning. We all know that price is delivered in zigzag motion, impulse and corrective swings, which is the basis of price action. The smallest trending unit of this move is what is called the ABCD swing. Trading lessons teach traders to enter on C, place stops at A and target D. Also, if price breaks the A level, traders are taught to take the reverse of the trade. This means that stops and limit are piled up below this A point, which makes it a liquidity price zone. As price action continues, new trends form, which all starts from the ABCD swing. Every A point on a new swing is a liquidity zone. Let's go through the chart and mark up some liquidity zones. Here we have the 1 hour chart of the pound against US dollar. The first clear visible new swing starts right here with this ABCD swing. That makes this a liquidity zone. The liquidity zone was tapped right here and price moved up, creating a new ABCD swing, leaving this as a liquidity zone. At this high, price reversed, creating a new ABCD swing, which makes this a liquidity zone. Price dropped into the previous liquidity zone right here. Here we got another change in direction that started with this ABCD swing, which makes this a liquidity zone. At this high, we also add a new ABCD swing to the downside, leaving us with this as a liquidity zone. From there, price dropped into our old liquidity zone, from where it reversed and left this as the last liquidity zone on the screen. How to apply these liquidity concepts to your trading? A single retail liquidity zone is less significant, as it can't house enough liquidity to pair institutional order because these orders are so huge compared to the amount of retail liquidity available at the zone. This reason forms the basis for the concept of liquidity pool. A liquidity pool is an area that houses more than one liquidity zone, so it may be 2, 3 or more untapped liquidity zones. The illustration on the screen right now shows 2 liquidity zones that are untapped. We have one here, as you can see, the ABCD swing, and we have another one here with this ABCD swing. The combination of these 2 liquidity zones create a lot more liquidities that can be considered as useful or significant to institutional traders. Because of this, they use it as targets and as entries. Targets to offload their old positions and entries to pair their new orders. Let's go through various ways liquidity pools are structured and used. The first structure we are going to consider is what I call the instant liquidity run. In this structure, two or more liquidity zones are lined up closely to make the liquidity pool, as seen in the illustration on your screen right now. We have liquidity zone 1 and liquidity zone 2 very close to each other, almost on the same price, followed by a liquidity run of both liquidity zones at the same time. For the second structure, we have a similar setup, but the liquidity zone in this case are separated. Also, the liquidity run is done one after the other. Price runs the second liquidity zone first, retraces, then runs the first liquidity zone. This last illustration shows a complete buy setup from entry liquidity pool to take profit liquidity pool. In addition to the liquidity pool concept, there is a second option, which is the use of consecutive liquidity zones. From previous examples, multiple liquidity zones are created to be run simultaneously. This is not always the case. Sometimes smart money use consecutive liquidity price zones to pair their orders instead of liquidity pool. This model forms the basis of the infamous Wyckoff accumulation and distribution schematics. This one after the other model can be used to pair new orders or offload old positions. The difference between this and the liquidity pool model is that pairing of order in this case is done in batches. As you can see in the illustration on your screen, we have the first ABCD swing, which creates the first liquidity zone, which was taken out right here, after which another ABCD swing was formed, creating a second liquidity zone, which was then taken out right here. So instead of taking out both liquidity zones at the same time, it was done in stages. First stage right here and the second stage right here. In summary, a liquidity price zone is tapped, followed by immediate creation of a new liquidity price zone, which is then tapped to pair the remaining orders or position. The disadvantage of this model is that it is difficult to know when the pairing is complete. The completion is commonly on second liquidity run or third liquidity run. Right now, let's go straight into the charts and see how all this looks with candlesticks. Here we have a 1 hour chart of the Euro USD. By now, I want to assume you all can spot a liquidity zone using new ABCD swings. If you can't do this yet, I'll advise you to rewind the video and get that covered before proceeding, because right now I will only mark liquidity zones without pointing out the ABCD swings or the new trend formation. In addition to that, only liquidity zones that make up liquidity pools or consecutive liquidity runs will be marked. At this low, we have a liquidity zone, and here at almost the same price level, we have a second liquidity zone. Both zones are untapped, which makes this area a liquidity pool. Price ran into the liquidity pool right here, giving the institutional traders enough liquidity to enter their buy trade. That resulted in this bullish move. At this high, we have a liquidity zone. Here we have another minor one, which was tapped here, resulting in this down move. Here we have a liquidity zone, which was tapped here, causing this sell. Those are minor trends. On the major trends, we have this liquidity zone here, which was tapped here, after which a new liquidity zone was created, which was then taken out here to complete the consecutive liquidity run model. The resulting move is this sell. Here is another time range on the Euro USD H1 chart. At this high, we have a liquidity zone. It was tapped here, after which a new liquidity zone was created here, which was also tapped to complete the consecutive liquidity run model. This is the resulting bearish move. Just opposite that, we have this liquidity zone here. We also have another one right here, which was tapped here, after which a new one was created here, which was tapped right here to complete the consecutive liquidity run structure. While that was setting up, we also have this untapped liquidity zone here, in addition with this new one right here, forming a liquidity pool that was also tapped by the same push that completed the consecutive liquidity run model. This bullish move is the result. At this high, a new liquidity zone was created. Similarly here, a new liquidity zone was created, which makes the combination of both a liquidity pool. The liquidity pool was tapped right here, giving the institutions the opportunity to open their sell position. Here is the resulting bearish move. If you are getting value from this video, give it a thumbs up right now. Now that you have seen both liquidity pool and consecutive liquidity run models on the charts. Let's relate this with the lesson from our last video on time frame selection. If you haven't seen that video, make sure you watch it immediately after this one so as to get a full understanding of the concept. Here we have a chart of the Euro US dollar for the last 2 weeks, which is 18th of July to the 29th of July 2020. The first intra-week contract, which is Monday-Tuesday trading, gave us this high right here, which was used as liquidity to pair the sell order in the second half of the week. The sell order was done using the consecutive liquidity run model. At the Monday-Tuesday high, we had this ABCD swing, which make the high a liquidity zone. The liquidity zone was tapped right here, after which a new liquidity zone was created. The new liquidity zone was tapped here, completing the consecutive liquidity run model. This resulted in this sell move. In the second week, Monday-Tuesday gave us this low, which was used as liquidity to pair the buy order in the second half of the week, just as explained in our previous video on time frame selection. Similar to the first week, the buy order followed the consecutive liquidity run model. The low on Friday marks the beginning of a new ABCD swing, which makes the low a liquidity zone. The zone was tapped here, after which a new liquidity zone was created at the low of Monday-Tuesday trading. The new liquidity zone was then tapped on Wednesday to complete the consecutive liquidity run model. Here is the resulting bullish move. It is that simple. We have no use for trend line, no use for order block, indicator, support and resistance, and all other retail jargons. If the analysis is a bit complicated to you, you can watch and rewatch the video for as many times as you need to understand the concept. If you got value from this video, give it a thumbs up and share it so as to reach more people and help the community grow faster. If you have any question, you can leave it in the comment section or DM me on Instagram. I'll try my best to answer as many as I can. That's it for this video. I'll see you on the next one. Keep trading, keep catching pips. Peace out.